Since the beginning of May, the renminbi exchange rate has been on a consistent downward trend. On May 17th, it broke through the integer threshold of $1 to 7 renminbi. By June 30th, the US dollar to offshore renminbi exchange rate was approaching 7.27, a new low since November 2021. Since the start of the year, the onshore renminbi has depreciated by about 4% against the US dollar, and the offshore rate has fallen by approximately 4.5%. Trang Thuy, an emerging markets foreign exchange strategist at Macquarie Group, suggests that, according to the renminbi's real effective exchange rate against a basket of currencies from the Bank for International Settlements, the renminbi is essentially at its lowest level since 2014. Entering July, the U.S. Federal Reserve's pause in interest rate hikes led to a pullback in the U.S. dollar index. Alongside this, Chinese state-owned banks counterattacked by selling us dollars in the spot foreign exchange market to prop up the renminbi exchange rate. On July 15th, the offshore renminbi exchange rate rebounded to $1 against 7.16 renminbi, but it still remained above the line of 7. The Chinese government generally regards 7 as a target line exceeding it is referred to as breaking 7. Long-term retention above 7 implies profound implications for trade, investment, and the overall economic environment. With the rebound in the renminbi exchange rate in July, people not only question whether this indicates stability in the renminbi, but also whether it will continue to fall, even dropping back to around $1 to 8 renminbi, the rate when China initiated currency reforms in 2005. In terms of the sharp fall in the renminbi exchange rate, Chinese public opinion generally holds that this is a deliberate move by the People's Bank of China, primarily for two purposes: to make it easier for countries around the world to purchase and possess low-priced renminbi, thereby accelerating the internationalization of the renminbi and replacing the US dollar, and to stimulate export trade. But is it genuinely a deliberate act by China's central bank? Replacing the US dollar, renminbi internationalization implies the discarding of the US dollar, allowing the renminbi to circulate outside China and become an international pricing, reserve, and settlement currency. Since the late 2000s, China has been pushing for renminbi internationalization. However, it's evident that the idea of replacing the US dollar is unrealistic. Currently, the US dollar is the most widely used currency in the world, accounting for approximately 90% of global currency transactions. Moreover, nearly 60% of foreign exchange reserves held by central banks worldwide are in US dollars, or its equivalents. Whether it's China or Russia, conducting international trade without the US dollar is implausible. Although trade between China and Russia has achieved dollarization, the majority of international trades outside of these two nations still require the US dollar as the primary payment currency. According to the official currency composition of official foreign exchange reserves, COFR, data released by the International Monetary Fund recently, by the end of the first quarter of 2023, the US dollar accounted for 59% of global foreign exchange reserves, making it the most widely held reserve currency by central banks worldwide. It was followed by the euro, 19.8%, the Japanese yen, 5.5%, the British pound, 4.9%, and the Chinese yuan, 2.9%, which only ranked 5th. Following the outbreak of the Russo-Ukrainian War, Russia faced economic sanctions from the international community, which limited its ability to acquire dollars and euros. Coupled with the underwhelming U.S. economic growth last year, China perceived an opportunity and began vigorously promoting yuan settlements with countries such as Russia, Saudi Arabia, and Brazil. However, reality did not meet expectations. Most countries that reached currency settlement agreements with China are resource-based, with China buying more from them and selling less. Upon receiving yuan, these countries did not continue to hold it or facilitate a two-way flow of yuan in international trade. For instance, Saudi Arabia converted the received yuan into gold in Shanghai, and only a small portion of trade between China and Brazil was settled in yuan. After all, the yuan only accounts for less than 2% of global trade payments. As for Russia, although the Russo-Ukrainian War led to a surge in Sino-Russian trade settled in yuan, China bought more from and sold less to Russia. Over the last year and the first 5 months of this year, Russia accumulated a trade surplus of 300 billion yuan. As Russia needs many things that China cannot provide and can only be purchased with dollars or euros. Especially since Ukraine began to counterattack in May, Russia's war readiness escalated and its expenditure increased. To obtain electronic equipment and advanced process chips, Russia had to sell yuan and purchase with dollars or euros. Thus, the grand scheme of yuan internationalization backfired, becoming a botched project. According to data released by the Society for Worldwide Interbank Financial Telecommunication, SWIFT, in January 2023, the international payment ratio of the US dollar reached 40.1%, making it the most widely used currency for international payments. It was followed by the euro, 37.9%, the British pound, 6.6%, the Japanese yen, 3.2%, and the Chinese yuan ranking 5th globally with a payment ratio of 1.9%, a 20% drop compared to 2 years prior, 2.4%. Economic commentator Li Shimin said in an interview with Radio Free Asia on June 27th, when the international market lacks the capacity to accept yuan, it only causes the yuan exchange rate to fall. If I get yuan, should I stash it away? At least I should have something to buy. But the problem is that there is no international yuan bond, which means I cannot earn interest on the yuan I hold. Therefore, my first move is either you, mainland China, sell me something I want, or if there's no export goods, I will sell yuan for dollars. And this is the reason for the offshore yuan depreciation. Clearly, the depreciation of the yuan exchange rate is not a deliberate act by the Chinese Communist Party. Offshore renminbi, the primary catalyst for exchange rate decline. Understanding the term offshore renminbi requires us to delve into what it signifies and how its existence impacts the renminbi exchange rate. China, as a one-party dictatorship ruled by the Chinese Communist Party, strictly limits domestic citizens' foreign currency exchange capacity. Beyond an annual limit of $50,000 per person for foreign exchange, purpose declaration forms must also be filled. Meanwhile, the People's Bank of China manipulates renminbi exchange rate fluctuations to enhance its competitive advantage in international trade, particularly against the U.S. On August 5, 2019, the U.S. formally labeled China a currency manipulator, stating under Section 3004 of the Omnibus Trade and Competitiveness Act of 1988 that China is a currency manipulator and meets the criteria of achieving unfair competitive advantage through large interventions in the foreign exchange market. However, from the occasional renminbi exchange rate fluctuations in recent years, particularly the significant depreciation in June this year, it appears that the renminbi exchange rate is not always under the complete control of the Chinese government. Why would a country known for currency manipulation experience such an uncontrollable situation? The crucial factor lies in the existence of the offshore renminbi exchange rate market. It is primarily the uncontrolled offshore renminbi that led to a sharp drop in the renminbi exchange rate. Offshore renminbi is relative to onshore renminbi. As the name suggests, onshore refers to the market within mainland China, while offshore denotes the market outside mainland China. Correspondingly, onshore renminbi refers to renminbi deposit and loan operations within China, while offshore renminbi signifies renminbi deposit and loan operations conducted outside China. Since offshore renminbi is less influenced by Chinese government regulation and interference, its exchange rate is more affected by market demand, resulting in greater price volatility than onshore renminbi. While there can be short-term disparities between the exchange rates of onshore and offshore renminbi, They generally follow a similar long-term trend. Among offshore renminbi trading centers, Hong Kong and London are the two largest, with Russia most likely to have unloaded a significant amount of renminbi in Hong Kong. Besides, Russia's substantial renminbi sell-off, a series of factors, including the Federal Reserve's continual rate hikes this year, insufficient Chinese foreign exchange reserves, and the downturn in China's economy, led to a decline in the offshore renminbi exchange rate, thereby putting the downward pressure on the onshore renminbi exchange rate as well. Offshore renminbi, the barometer reflecting the trend of renminbi exchange rate and China's economic condition. Due to China's limited and unsustainable intervention in offshore renminbi exchange rate fluctuations, the uncontrolled offshore renminbi has indirectly become a barometer that influences the trend of the renminbi exchange rate and reflects China's economic issues. The substantial decline in the exchange rate of renminbi against the US dollar that began in June this year has unveiled several layers of the harsh economic problems China is facing. 1. The economy continues to struggle, with main economic indicators showing a comprehensive decline that seems irreversible after a short-lived retaliatory rebound post-pandemic. On June 15, the National Bureau of Statistics of China revealed May's economic data, indicating a continuation of the economic slump from April. A key indicator of consumer confidence, retail growth, was only 12.7%, lower than the expected growth of 13.6% and well below April's 18.4%. Real estate investment saw the steepest decline since at least 2001, dropping 21.5% year-on-year. 2. The total amount of China's imports and exports continues to shrink, especially apparent in the significant drop in exports to the United States. From January to May this year, China's total exports to the United States decreased by 25% year-on-year. In terms of the proportion of import trade, China has been overtaken by Canada and Mexico, and the gap continues to widen. According to a report by Radio Free Asia, on July 13, the General Administration of Customs of China announced that, in dollar terms, exports decreased by 12.4% year-on-year in June, imports decreased by 6.8%, and the trade surplus was $70.62 billion. If priced in renminbi, exports in June decreased by 8.3%, imports fell by 2.6%, and the trade surplus was 491.25 billion yuan. China's imports and exports have declined for 2 consecutive months, with the decline for 2 consecutive months, with the decline increasing. Reuters reported that China's June exports marked the biggest decline since the COVID-19 outbreak in 2020. 3. China's foreign exchange income and reserves, primarily denominated in US dollars, are significantly insufficient, making it difficult to maintain the stability of the offshore renminbi through the sale of an adequate amount of US dollars abroad. The information on foreign exchange reserves at the end of June 2023, published by the State Administration of Foreign Exchange on July 8, stated that China's foreign exchange reserve scale is 3.19 trillion US dollars. Even if this figure is accurate, the included foreign debt is equivalent to 2.45 trillion US dollar, accounting for 76.8% of the foreign exchange reserves. Simply put, during economic downturns, unless it disregards the risk of foreign debt default, the Chinese government's available foreign exchange reserves are actually very limited. Related data is as follows. 1. The Official Reserve Assets 2023 published by the State Administration of Foreign Exchange on July 7 shows that the foreign exchange reserves in June were 3.19 trillion US dollar. 2. The situation of China's foreign debt balance at the end of 2022, announced by the National Development and Reform Commission on April 8, shows that as of the end of 2022, the total, including domestic and foreign currency, foreign debt balance in China was 17.8 trillion renminbi, equivalent to 2.45 trillion US dollar.